Hello and welcome back to the ROI podcast. Return on investment, the art and science of return on investment is what we're interested today. And I have the great pleasure of introducing a new guest to the channel. This man knows quite a lot about return on investment. We're going to be picking the brain of the unemployed value Degen. Don't let the name fool you. He's a very, very smart guy. He's been around the traps for quite some time. It is my great pleasure to introduce you, Unemployed Value Degen. How are you, sir?
I'm very well. Thank you very much for having me. Every retweet and restack goes a very, very long way, and I'm grateful for all of it.
The pleasure is mine, sir. I'm a great fan of your content. Always enjoyable to meet another value Degen. Before we get going, guys, a disclaimer, nothing we say is to be construed as advice. We're two value Degens having a chat across the ocean. So enter at your own risk and caveat emptor. Uh, I'd love to start with you in terms of your background. If you'd be kind enough to give us a 2-minute synopsis, perhaps, of your upbringing, what got you into the field of investments, and in particular, what made you choose value investing as your preferred approach?
Oh, wow. Well, what got me into investing in the first place was I had the bad judgment to major in economics. And after I graduated, I had to find a job. So I went to work as a financial advisor. I think the other day you were interviewing Rick Rule, and he was, poking fun at some newsletter writer who, works in sales and doesn't know anything. It cut me pretty deep. But I was at one time slinging BlackRock Global Allocation Fund to your grandparents and to your parents and things like that.
Okay, there you go. And so you entered the corporate world. You were there for how long before you decided you wanted to make a change?
Oh, a very, very brief period of time. I only lasted a year in that job, and it was a wonderful opportunity. It was a perfectly fine job. I wasn't at the point in my life personally where I was ready to just put down a flag and say, this is where I'm going to be forever, and attend the Chamber of Commerce and be a pillar of the community. I wasn't married, I didn't have any kids, and I still wanted to travel. So I left it was at Merrill Lynch. I left Merrill Lynch and went to work for a British firm that was doing the same thing, but to expats overseas. I spent a couple years in the Philippines. That was a wild place. Um, uh, I learned a lot, but I didn't make very much money. Um, and I was so roughed up by spending 2 years in the Philippines that I came back and went to grad school. Not having learned my lesson the first time, I doubled down in economics, which was a terrible value decision. And but while I was in grad school, I met a wonderful woman who I'm now married to, and we have 2 kids together. But she was in a PhD program, so I said, "Oh, geez, now I have to join a PhD program so that I'm around her long enough to get her to marry me." So I entered the PhD program in finance. I did all but dissertation. To me, academic research is for the birds. You can call it sour grapes if you want to, but that world is such a wasteland, and I just didn't have it in me.
Okay, so you two academics in the house. The poor kids, what chance do they have growing up with the two academic parents? No, I like it. That's super interesting. And you've made your way over to the dark side of the entrepreneur scrappy value degens. So from there, you start to write about your experiences. How did you get into value investing? So a lot of the people that go via the, let's call it the academic silo, tend to end up in the quant field, quantitative analysis, and I've met plenty of those guys who do very well. Why value investing? What was it about that particular methodology that attracted you?
Well, I've had all the math from the PhD program. I've taken so many statistics and econometrics classes, but uh, I was always looking to get a bargain. So I would sit on extra classes if the professor would let me in for free. And I ended up in a graduate probability theory class. And when you finally scratch the surface and you dig all the way down to the bottom and you see what probability theory is based on, you end up with a lot less confidence in it. There's this old Einstein quote that as far as math is certain, it's not real. And as far as it's real, it's not certain. I think that whenever I see a financial report and it says, 13.72% internal rate of return, is it okay? You have maybe at most one significant digit. I started in chemistry once upon a time, and I always think in terms of when you're doing an experiment, you have to keep track of what's your fewest number of significant digits. And in finance, it's usually maybe 1 or 0. So you can put all this advanced math on top of it. But so in my write-ups, I have a background in math, but when I say where I think the position will go in time, I say, well, maybe it'll 3x, maybe it'll 4x. Who knows? Give it 5 years, see what happens.
There's so much to what you say. So you want to be roughly right as opposed to precisely wrong. And 3x, 4x, well, it really depends. As you said, one significant digit. If you start to make small errors in the DCF model, then when you extrapolate that out over 5, 7, 10 years, obviously the effects can be quite vast. In terms of your approach to investing, let's say you are looking at a new opportunity. What sort of filters or thoughts go through your mind initially? Do you look at cash flows and you're trying to come up with a discounted cash flow model? Do you look at asset value and you're trying to get a good idea of a tangible asset value and buy it at a good discount to that value? What goes through your mind? What's your preferred investment methodology?
Well, it's kind of a fun puzzle because every industry is so different. They all have their own metrics that work for that industry. And if you're going to be a generalist, well, then everything is a whole new problem that you've never seen before. So sometimes book value is useful, sometimes it's not. Sometimes earnings is useful, sometimes it's not. Everything is case by case. You asked me, kind of what got me into the value mentality, because in the academic world, you start with efficient market theory things, and that's probably somewhat accurate for the mega cap companies. Although I did see Facebook, get cut by 3/4 and then triple. But I was to try and overcome the problem of the fact that every industry has their own valuation, their own valuation metrics. I was looking at distressed debt. I said, aha, if the debt's distressed, then the market thinks that they're in trouble. So if I can find a situation where I think they're fine and the market thinks that they're in trouble, then even if I don't know in that industry what metrics are the best, I might be able to find something there. And when I was digging through distressed debt, that's how I found Transocean. And I think at the time the oil price was $100 a barrel. And I said, how in the world can the oil price be $100 a barrel and the marketplace thinks that an oil services company is going out of business? That doesn't make sense. That does not compute. So I dug into it, and you keep digging and you keep digging and you keep digging, and then I found out that onshore for shale oil, marginal prices had risen to about $65 a barrel, and offshore the prices had fallen to about $45 a barrel. So if you're the low cost provider of the next barrel of oil, the equipment is going to be leased and they're going to get a good rate of return. And so that was kind of the first thing that really broke me out of efficient market thinking. Here was a company, my first buy was at $236 a share, and I think the market cap was $2 billion for something that had $20 billion of equipment and $10 billion of liabilities and $6 billion in accumulated depreciation because they haven't been profitable for a while. I mean, even if they just paid out depreciation and dividends, it would be a 10x. I mean, it's just an outrageous mispricing. And if the equipment is going to get rented because cost for a barrel of oil offshore is $45 and it's $65 onshore, then it didn't seem risky to me. So the market thought they were going out of business, but it didn't seem risky to me. So I think that's what I like about value the most is I think value gives me the courage to make a large position.
You are speaking my language, sir. In terms of positions, how many positions would you normally run in your portfolio? And I understand that obviously that's kind of a moving target depending on the market environment. But do you prefer to have fewer positions that you can really understand and then alternate, adjust your position sizing in accordance with changes in the thesis? How many positions would you normally run, and what percentage allocation do you tend to find yourself allocating to your best ideas?
Well, I have been keeping around 10 to 15 positions, but now that I can be digging into companies full time, because for the last 5 years I've been teaching finance to undergraduates at a university before I became the unemployed value Degen. While I was working full time, you can't really keep track of more than 10 companies. And if you're not watching it, it's well, at that time I could only really keep track of 10 to 15 companies. I think I can keep track of more now, but some of the value situations are so extreme that like we talked before the show, Medical Properties Trust, they're acute care hospitals and they're 44 cents on the dollar.
Let's talk
And
about
I
that. Let's
haven't,
go deep. Let's go deep here.
yeah. So how much of your portfolio should you put into something that, I mean, how can being the landlord of an acute care hospital, how could that come back to bite you in the butt? Where is the risk of technological obsolescence? Where is the world where nobody ever has a heart attack again or nobody ever has a stroke again? How can this be a bad idea? I just finished writing it up. I'll probably release it next week. There's a real estate company called the St. Joe Company in the Panhandle in Florida. And the guy who's the chairman of the board, his hedge fund has an 86% allocation of the St. Joe Company, which is extreme. Even Charlie Munger said, oh, there are some ideas so good if you don't put 50% into it, it's a mistake. And this guy has 86% in one holding, but it's 171,000 acres of Florida real estate. I think the thinking is, how can you possibly mess this thing up? What could possibly go wrong to have 171,000 acres of Florida real estate, most of it, within a few miles of the beach? So I think I don't mind a concentrated position if it's such a no-brainer that, I can keep digging and keep digging and keep digging, but it's just so hard to find the risk. It's hard to find the negative outcome. So when it comes to acute care hospitals at 44 cents on the dollar, or 171,000 acres of Florida, waterfront real estate, things like that you could have a bigger position on. But you had reached out to me after I wrote about Vertex Energy, a refinery in Alabama, and that there really is a binary uncertainty. They could go out of business, right? There's really a chance there that they don't make it. So obviously I'd put a much smaller weight on that one.
Yeah, indeed. Let's continue down the Vertex pathway just because you mentioned it. So to me, I exited Vertex not on price drop, but because a change in what I thought the idea was in terms of where Ben was going with that business. My idea was they bought a brilliant refinery, 75 mil, like a massive, massive discount to rebuilding this thing. They were printing somewhere in the neighborhood of 40, 50 mil free cash per quarter. And all they had to they had half of the debt maturities in cash. All they had to do was just pay down the damn debt, sell off some non-core assets, and then they made these announcements that wasn't going to happen. So I said, okay, I'm out. There's a similar idea in kind of similar in terms of Sibanye Stillwater. I think that Sibanye Stillwater, if I write off the South African assets completely to zero, I still think their ex-South African assets are worth multiples of the current enterprise value. How do you view those two situations where you're looking really at an asset value, and what could go wrong is a question that you mentioned. What can go wrong for Vertex and what can go wrong potentially for Sibanye? And can they, even if those things do go wrong, can an investor still have a successful outcome?
And so in the case of Vertex, I was attracted to that purchase, that $75 million for a refinery that's insured for $1 billion. And there was even a news article recently, somebody is applying to build a new major refinery in the United States for the first time since 1977. And it's exactly twice the size, and it is estimated to cost between $3 and $4 billion. So it's a $2 billion rebuild cost for the Vertex refinery is probably pretty accurate. So this is an amazing acquisition, an amazing asset. But I look a lot at insider purchases, especially if it's not a director, but a corporate officer, and especially it's the chief financial officer. But having followed insider buying for a long time, insiders generally know if their business is well run, but about half the time they're totally clueless about the cycles that affect their business. And I think this happened in the case of Vertex, is there was a CapEx boom and bust in the renewable diesel space. You've got California and Canada, which are mandating renewable diesel at the pumps. They're going to be making diesel out of soybeans, some astronomical number, 47% of US soybeans is being turned into renewable diesel. And I'm highly suspicious that it probably takes more than a gallon of diesel in tractors and fertilizer to make a gallon of renewable diesel. And the whole thing sounds completely insane to me. But I flew out to Houston and I met with a couple of the executives from Vertex last February because I wanted to see where their heads were at. I wanted to see, are these guys, have they bought into the green dream hook, line, and sinker, or are they just pragmatic? And, you know, if California mandates this thing, then we can provide it and collect a profit margin. And I did get the feeling that 3 out of 4 of the C-suite management team were pragmatists. They were not, you know, green energy fanatics. And they did have a green energy fanatic, but I think his role was interfacing with all the other green energy fanatics. I think they were, you know, decent business people who misread the cyclicality of the business. They zigged when they should have zagged. They focused on building out the renewable space rather than streamlining the traditional space. And the chief operating officer, he's a traditional oil and gas guy. He was leaning towards, you know, streamlining the traditional refinery because Shell was using the refinery for intermediate products because they have this huge network. But if it's your only refinery, you have to make finished products. They still have a lot of efficiencies they could unlock there to increase the profit margins, but they just did the wrong thing because there was a boom and bust in renewable capex, and the whole market is in a lull now and might be for a couple more years. So I'm not super fond of the renewable space, but I think the leadership team is mostly pragmatic and then misread the cycle and did the wrong thing. I mean, it could potentially be fatal. They've got $200 million of debt, which is a floating rate, and it's charging them 16%. But they also have a legacy business in Louisiana. So the CEO started out doing used motor oil recycling, you know, collecting used motor oil and recycling it into renewable diesel that way. That legacy business in Louisiana, they sold the Ohio business for 90 million, and at a comparable, the Louisiana business would be worth 200 million. And the management team said that, you know, if they got the right offer, they would sell it. They're not nostalgic. Well, they could wipe out the debt that way, and then they could let the traditional refinery just, you know, produce a lot of cash.
That's what I
They
was
could also
hoping for.
just, yeah, that's what everybody's hoping for, and we're all waiting for it. They could also just refinance. Now the execution risk is gone from getting the refinery operating. And so the CFO told me that they could, you know, probably refinance in a 10 to 12% range instead of a 16% range. But right now, what they really want is what Calumet did in Montana, which is to sell a part of the refinery to a joint venture partner and raise money that way to pay off the debt. And they started this roadshow process with Bank of America to bring in a bunch of suitors and find a joint venture partner. And when I had visited in February, that was just after they all had visited the headquarters, and all of the, you know, potential suitors were at that point visiting the refinery in Alabama. And you know, the process takes time. I mean, we could hear about it any day, whether it succeeded or failed to find a joint venture partner. And it, you know, there was enough interest, and the capital markets are open. We saw we had an IPO for Reddit. We've got $2 trillion in private equity and $3 trillion in private credit. And you've got a merger and acquisition wave in the oil and gas space, right? Exxon is buying stuff and everybody's buying something. There's mergers everywhere. So to me, the odds of a joint venture happening, raising $200 million and paying down all the debt, I still think it's a pretty good chance. You know, the capital markets are open. So you could just get a press release tomorrow, next week, a month from now, saying, you know, their problems are behind them. And now there's going to be a lot better, you know, a lot more of the gross profit might actually show up as profit.
Yeah, indeed. So let's take a binary approach. Let's say in the event of a bankruptcy, let's just look at worst case scenario. Is there any chance that equity holders would reclaim anything from those asset sales, given that they're worth so much more than what they've been accounted for? Or is it just going to be a case of, no, they've got too much debt, it's just forget about it. Senior debt holders are going to get paid out, and then that's it.
Well, I asked the CFO if there was a bankruptcy liquidation, what he thinks the parts of the company would sell for.
Indeed.
He told me maybe somewhere around $600 million. Well, they only have 200 million in debt and $100 million market cap. So that's, a 3x or 4x from here if they went through bankruptcy. So, um, they have runway. Their capital structure is upside down, mostly because their stock price is in the toilet. Um, you know, I've seen a lot of companies in a similar position, able to get a really attractive interest rate on convertible debt. It wouldn't surprise me if they could issue a $200 million convertible bond, and depending at what strike price it executed at, and they could retire the debt that way. And I know it would be dilutive and nobody wants that, but you're still talking about, a $1 billion refinery, $200 million recycling business. And then I'm less of a believer in this, but the renewable diesel. If Canada and California are so insistent on this, then that, will be a viable business. It's just in the toilet right now.
Yeah, very interesting. And let's say they do get the liquidity that they need, perhaps dilutive, perhaps not. What do you think the company could be worth, let's say, in a few years' time, based on the cash it can produce? So we've got the asset valuation backing us. Let's say they can reduce the debt and start to produce some healthy amounts of free cash. What kind of multiple could that attract? What kind of cash could it produce? And ultimately, what sort of valuation ballpark are you thinking for Vertex?
Yeah, it's tough to hit that moving target because they have a lot of efficiencies they can still gain on the traditional refining. They spent all this money making the renewable refining, but they didn't spend it on the traditional refining. I think around Q3 of this year, their Texas tower comes online. So they did spend money around the edges, putting in a piece of equipment called the Texas tower, which captures heat. So it makes the process of turning crude oil into diesel and gasoline, that cracking process, more efficient. They could get 2, 3, 4% more of the stuff that sells for a high price. And you also have in the middle of next year. So I mentioned this in my Substack article, and they had mentioned this on earnings calls, but I don't think anybody understood what they were talking about. When Vertex was the bidder for the refinery from Shell, they weren't the highest bidder, but they were willing to work with Shell and let them take profits from the refinery in other ways. So the Mobile refinery is on a deepwater port, and it has storage tanks and a truck ramp. That's kind of like the gasoline wholesaling business. So if the gas station is the retailer and the refinery is the manufacturer, you also have the wholesaler. So the business where the trucks come to fill up the gas stations fill up at the closest deepwater port. And there's about 10,000 customers where their deepwater port is Mobile, Alabama. If there was no refinery there, tankers would come to that deepwater port. They would unload diesel and gasoline into those tanks, and then the trucks would go there to pick up the gasoline and bring it to the gas stations. That business by itself probably generates some profits, $25 to $35 million a year. And Vertex allowed Shell to keep earning that money for 3 or 4 years after acquisition. So Shell got to keep, even though they only got paid $75 million for the refinery, there's an extra, $100 to $150 million for Shell over time. But Vertex has already paid for this and they're going to inherit it. So you're just going to have in the middle of next year, here's a swing, extra $25, $35 million of profit as they get to take over that whole other business. And add on top of that, the efficiency gains from optimizing the traditional refinery, depending on where crack spreads are. They could easily make, I crunched the numbers a while back, but they could easily make $40, $50 million a quarter off of this business. And if a company's making $200 million a year, what do you price it at? I know refineries don't fetch a high multiple, but it easily could go for half of, it's not really a book value because they paid so little for it, but half a rebuild cost. So there's no reason it couldn't be $1 billion market cap. There's no reason it couldn't be $10 a share. And that's without, earning money for some sustained period of time and returning capital to shareholders or doing something else with it.
Yeah, very interesting. In that wholesale aspect that you mentioned, or midstream is how I would think of it, what's the business model for them to receive revenues there? Do they charge transit fees for the trucks coming in, holding fees for the tanks? How do they make their money there?
So the price the gas stations pay to Shell is different from the price that Shell pays to Vertex. Right? So Vertex is paying to Shell just at global market rates, and then Shell has the markup before it goes to the gas stations. So there's an extra profitability there. And another thing I like about Vertex, so that the CEO, we'd call him Scrappy because he creates new verticals. So they've already started taking, so the first of the products that went off of this, international prices that Shell would get the wholesale markup was bunker fuel. So this heavy black oil, it's at the lowest value at the bottom of the chromatograph where they separate the column. So the bunker fuel, rather than selling that to wholesalers, they've been finding customers themselves and trucking the bunker fuels to other ports nearby and loading it directly onto different dry bulk ships and things like that. So they've been trying to capture more of the profit margin, going directly to customers and cutting out wholesalers. So the CEO is scrappy, creates new verticals. There's a lot of stuff I like about it. I just don't like that the stock price has fallen, I don't know, 75% since where I bought it. But they're doing a lot of things right.
Yeah, it's super interesting. And this price seems to have bottomed out, at least for now. And with the opportunity of a 10x, what kind of weighting are we thinking here? So we thinking
Yeah,
1%?
I mean, I have a higher weighting now than I would if I initiated the position, because after the price fell, I had to buy more at that lower price because I wanted at least to have some of that position, bought in pretty close to the bottom. I have it in me to catch falling knives. The only time I've ever caught the bottom exactly is because I was in there before the bottom and I caught the falling knife. But sometimes I do size up the position too large on the way down. I did that with Medical Properties Trust. The position was already so big that I couldn't buy any more at $3. I still, for the life of me, couldn't believe that acute care hospitals would sell for 25 cents on the dollar to tangible book. It just doesn't make any sense. So I kind of put all my chips on the table, in the $4 something range. And then it was painful on the way down. But, in the meantime, I'm still making money selling options and collecting dividends and waiting for it to go back to something like, I think long run, they get something like 80 cents to tangible book instead of 44 cents. So and I still can't figure out how you can possibly go out of business being the landlord of acute care hospitals.
Yeah, it's interesting. Let's take a deep dive here because it's something that's certainly fascinated me. It's been the target of short sellers. You're the landlord and you've got tenants, in this case, hospitals. How did you come up with an idea of its replacement cost or book value, first of all? And then why is it that this has been so targeted by the shorts currently?
I think the reason why it's targeted with shorts is because commercial real estate generally, if you lose a tenant, it's devastating. You're talking about a very thin margin business with triple net leases, where if you lose a tenant, you're now suddenly on the hook for property taxes, insurance, maintenance. And the tenants are so specific, you might be 6 to 12 months or more before you find the next tenant. So you're only making 5 or 6% in the meantime when it was tenanted. And now you have all this money out in property tax, maintenance, and insurance. Then you have to pay somebody like Colliers a commission to get a new tenant. The commission to Colliers is usually something like 4 months rent. And the industry standard right now is to give the new tenant something like 4 months free rent. So you're negative for a long time. And if you only have 1 or 2 commercial properties, it's devastating. So I can understand why, if you have terrible tenants, the market wouldn't like that. But this is what really shocked me for acute care hospitals. When your tenant goes bankrupt as an acute care hospital, the municipality and the judge will not allow the acute care hospital to be vacant. Right? You don't have to pay Colliers a commission to find a new tenant if the bankruptcy judge has an auction and finds a new tenant for you. Right? You don't have to pay that commission. You don't have 6 to 12 months of vacancy because the bankruptcy judge is going to find the new tenant for you immediately. And from the start of the bankruptcy process, all the new rent that's accrued is the new tenant's obligation. So Medical Properties Trust has 25% of their properties were tenanted by this a group called Steward Healthcare, and they really were the worst. I mean, this guy was, massive leverage, rapid expansion, total zero interest rate phenomenon character. And if interest rates stayed at zero, maybe he'd be hailed as a genius. But interest rates didn't stay at zero, and he went totally bust. And a lot of the short sellers focus on the bad behavior of this large tenant, and his behavior was terrible. And you could say, well, maybe Medical Properties Trust enabled him by doing the sale leasebacks for those facilities, but they're separate entities, or they're separate businesses. I think Medical Properties Trust figured out a long time ago that in acute care hospitals, you don't have to worry about having bad tenants because you never miss any rental payments. The bankruptcy judge does all the work for you, right? You don't have 6 to 12 months of paying property taxes, insurance, maintenance. You don't have to pay Colliers a commission. You don't have to give 4 months free rent to the tenant. The bankruptcy judge just takes care of all that for you. And if you look at Medical Properties Trust, as a REIT, they have to pay out 90% of their income. After paying out 90% of their income, they've compounded book value at 10.5% for the last 15 years. That's insane, right? How could you think about these guys as anything other than geniuses? I don't know. How do you compound book value at 10.5% while paying out 90% of your income? That's who would short somebody like that? I wouldn't short somebody like that. That's insane.
That was certainly the stat that caught my eye reading your work on this company. It's incredible capital allocation. As a foreigner, explain the situation to me. So are these private healthcare companies? Are these kind of state subsidized hospitals? How does this work in terms of finding new tenants?
So hospital operators are private companies, but I believe, kind of like the newspaper industry, they tend to be bad business people, right? You find hospital operators, sometimes it's a collection of doctors that come together and they think they can handle the business of operating a hospital. You also have a lot of problems in hospital operation that you're torn between. In the United States, we have most of your customers are either on insurance or they're on the government healthcare plan, Medicare. So you're constantly trying to collect your receivables from either insurance companies or Medicare. And that's its own giant mess of problems. And you also have the problem that when there's rapid inflation, your contracts will have been fixed with the insurance companies or for Medicare for the year. Meanwhile, your costs are going up at outrageous amounts. And they also had the problem that during the coronavirus pandemic, even though the government was throwing lots of money at them for coronavirus vaccines and things like that, so many people stayed away from hospitals for fear of, because during the MRSA pandemic, most of the people that caught MRSA caught it in the hospital. And so people were staying away from hospitals for all of their elective procedures, all of their cancer screenings. And this is going to bite every country in the butt going forward. People that didn't do their mammograms during the coronavirus pandemic, they didn't catch the cancer early, then it becomes much worse. But hospitals lost more money on the people that didn't go to the doctor during the coronavirus pandemic than they made from the government coronavirus stimulus. So the hospital operators were already stretched, they were already squeezed. And then on top of that, you had this sudden inflation wave, and they have all these contracts with insurance companies and Medicare for how much they are reimbursed for certain procedures. It's a tough time to be a hospital operator. But at the same time, Medical Properties Trust was doing sale leasebacks with probably the worst and most aggressive hospital operators. And I think on purpose. I think these guys in Alabama, Edward Aldag, I think he figured it out. I think he cracked the commercial real estate problem by focusing on acute care hospitals. So yeah, they have terrible tenants and they're going to be replaced with good tenants. And when that happens, the cap rate goes from 9 to 7 and all their properties are more valuable. And then they can sell those more valuable properties and they can use that money to do a sale leaseback to somebody who's a terrible tenant again. So that's how they've recycled capital and had a 10.5% growth of book value for the last 15 years.
So tell me more about these sale leaseback agreements. Given that it is, as you mentioned, a difficult business to operate profitably, a hospital, do they look for distressed operators and try and buy the underlying edifice or property and then do a lease back to a new operator? How have they been able to compound that book value at such a phenomenal rate? especially when 90% of their funds are distributed, as you said.
Yeah. So in commercial real estate, if you have an uncreditworthy tenant, a building for sale with an uncreditworthy tenant might sell at a cap rate of 9. So if you do your internal rate of return of 9%, the building will sell for less. If you have a creditworthy tenant, that building might sell at a cap rate of 7. And so that same building, even the same rent amount, they're paying the same number of dollars in rent, but the building would sell for much more. And my suspicion is that Medical Properties Trust, knowing that the legal system will defend the landlord, I think they go after the low creditworthy tenants. They will do a sale leaseback. They'll buy the hospital from somebody who's not creditworthy at a cap rate of 9. Now that operator, they might get acquired by somebody big. And if they get acquired by somebody big, well, all of their liabilities are now the liabilities of somebody creditworthy, and your hospital now has a cap rate of 7.
Yeah.
Or they might go bankrupt, and the judge might replace them with somebody better. And then your cap rate of 9 hospital becomes a cap rate of 7. So then when they have a good tenant, well, then they sell the hospital. They sell the hospital at a much higher price, take the money, and they do sale leasebacks to 2 hospitals with bad tenants with the money. That's how they've been able to
the property or the
compound.
going concern along with it.
So they have taken some small equity stakes in the operators. By the REIT, Real Estate Investment Trust rules, it always has to be less than 10%. That did cause a big loss with Steward. I don't think Medical Properties Trust thought Steward was going to go bankrupt, because I don't think they thought interest rates would go from 0 to 5. So I think they thought that over time, and Steward was, before they went bankrupt, Steward was in the process of trying to sell off some of its units. I think that they thought plan A would be the operators, sell parts themselves, and then your hospitals are suddenly operated by somebody creditworthy because the business is sold. I don't think bankruptcy is plan A, because Medical Properties Trust is probably going to take a several $100 million hit for their 9% ownership in Steward. That's a 0. Now they have other equity stakes, and probably I would love if they recycled this capital. They have about $2 or $3 billion in equity stakes in hospital operators. But the one that they have in Switzerland, an insurance group bought into the same hospital operator later at a higher price. So we already have a comp that some of their equity investments in the operators are, actually doing all right, doing pretty well. But yeah, I would love if they recycled that capital and put it into something that was actually paying rent, because they're a real estate investment trust. But they've been doing such a good job. I'm not going to thumb my nose at them, but they did take a hit from the equity stake in Steward. But they're going to make, when that 25% of their hospitals is suddenly tenanted by somebody more creditworthy, they're going to do all right. I mean, the only real risk is, and they do have 1 or 2 hospitals like this, where maybe the city is shrinking and the hospital just genuinely goes empty, that they no longer need a hospital there. That's a pretty rare phenomenon. They have 1 or 2 like that. But that's the real risk, is if the hospital is no longer a hospital, you're not collecting rent from anybody. But other than that, the bankruptcy judge is going to make sure that that hospital is operating.
Indeed, they are. And I think in terms of immigration trends, you'd have to choose somewhere fairly remote in order for that phenomenon to occur. How do you value the properties, and how do you value roughly the equity stakes? Can this company go bankrupt? Again, there's such a short interest. Why would there be such a short interest? What's the debt to equity situation on the company? What's the debt serviceability to their EBITDA? And why are people attacking this thing?
Yeah, so the debt, they focused on 10-year fixed rate debt. Now it's been a few years since interest rates have risen, so they have, I think their longest term debt now is out about 7 years. But their average interest rate is in the 4s. I think it's 4.19%, something like that. So they have fantastic debt. They shouldn't repay early. So to me, that's not a huge source of pain. Even though their largest tenant is going through bankruptcy, the other 3/4 of their tenants are paying their bills on time. Now, there's some accounting rules that when you make a write down, for some reason that shows up as income. So if you look at the write downs, it looks like they're losing money. But just from a pure cash in, cash out perspective, the three-fourths of their tenants that are paying rent, they're never losing money, right? They're just having three-fourths of their tenants paying rent. They can cover all of their interest service. They can cover all of their bills. I mean, I wouldn't short something that was, cash flow positive, has low interest rate, long-term fixed debt. It just really doesn't make any sense to me. If I just look at the historical comparables, in a normal time, they'll be at a price to book of about 0.8. And in a euphoria, they'll get to a price to book of over 1. I don't know if we'll ever see a euphoria anytime soon with interest rates having risen. But I bet it'll get back to, $10 a share, price to book of about 0.8. That wouldn't surprise me at all.
Okay. Price to book 0.8. We're valuing that at roughly $10 a share. It's certainly pique my interest. I'm going to be doing a further deep dive into that one. Peabody we haven't spoken about. It seems to just be forgotten amongst the coal sphere. I don't know why, probably because of their thermal mix. How do you value Peabody's prospects over the next decade? And what do you think it could be worth to a cash flow investor?
Well, I haven't finished a write-up on Peabody Energy, so I haven't put any multiples on it. I do have a small position. What I really like to do with Peabody Energy is I like to write puts on it, because one of their problems, one of the reasons people in the market don't like them, is they have this huge share buyback program. I think at the peak it was $1 billion for a 3 billion market cap company. So enough money to buy back a third of their float authorized. But then there's the difference between authorizing and spent. So they're dribbling out this share buyback slowly. I think what that does is that puts a pretty hard floor under the stock price. So it's a fantastic thing to sell puts on something that has an unspent, $800 or $900 million share buyback program on a 3 billion market cap company. Because if the price were to fall, hopefully they would spend a little bit more money on the share buyback. So as far as what they're going to do in the long run, I wrote about this in I think my Sibanye Stillwater write-up is the marketplace is obsessed with pure plays. There's not a lot of value investors as much as there are thesis investors. People will have a metallic coal thesis, and so they'll go to Warrior Met Coal. So people don't like companies that are mixed, and Peabody Energy has metallic coal and thermal coal. But their thermal coal is 3/4 international, sold overseas. It's only 1/4 domestic. And on their last conference call, and of course the CEO, it's good to be distrustful of management, just as a general rule, but the CEO said that the power companies are coming to them trying to make sure that they have more coal supply, because coal plants that were scheduled to be decommissioned, that decommissioning is going to be delayed because of the artificial intelligence boom. So they're 1/4 of the thermal coal that's domestic, but probably has some more life left in it. But 3/4 of the thermal coal is international. I don't know if you just saw the recent numbers of, how much coal power capacity India is going to bring online in 2025, but it's just enormous. I think the Western world went to the global South and said, hey, you should focus on natural gas because that produces half of the carbon dioxide. And the global South goes along with it, partially because, the IMF is the one, giving them the loans to do things. And, partially because I think the West still has some esteem. So for whatever reason, third world countries went along with the West, Europe and the United States, about building natural gas power plants. And then with the Ukraine war, when Russian gas was cut off from Europe, Europe said, well, we'll buy all the gas because we can afford it. And I think the third world felt really betrayed by that, because suddenly they built natural gas power plants. Now they can't afford the natural gas. That betrayal really rubbed a lot of countries the wrong way. And a lot of these countries, you look at the mob in Sri Lanka that stormed the president's palace, and the president, fleeing on a Navy boat. People in Pakistan and Bangladesh and South Africa, I think they're very aware that the palace can be stormed and they could be killed. So, and not having electricity is one of those problems. So I think for places like Pakistan, coal makes a lot of sense. You don't have to build storage tanks. You don't have to build pipelines. You don't have to build, regasification plant, import terminals. You don't have to worry about Europe buying up all the supply. I think you'll see in the third world, kind of a pivot back to coal after years of the of the West trying to tell them to only do natural gas. So I do think the international thermal coal market has a lot of life left in it.
Yeah, indeed. And in terms of Peabody selling those thermal coals to that part of the world, where do they sell mainly to? India, China? Who's their main customer?
Oh, that you'd probably have to ask Matt Warder. I know they ship out of the East Coast of the U.S. And I mean, people just pretty much buy from the shorter routes. I think, yeah, definitely ask Matt Warder that one. I'd say a chunk of it probably goes to Europe for their coal import needs, but yeah, it's an international market, right? So if one ship redirects from one port to another, then another port. I was in uh, I'm out of it because Eagle Bulk Shipping accepted getting acquired. So I was in the bulk shipping space because the shipyards were full of LNG tankers and oil tankers and cargo container ships. So it looked like the setup was pretty good for bulk tankers, that there were no new ones being built. The global economy grows. So I was watching the bulk shipping space for a while. And one of the things that drove up demand was a dramatic change in trade relationships. Suddenly, coal was going from Indonesia to Europe. And that was a trade pattern that had never existed before because it's just too far. It doesn't make any sense. But when everybody needed it to happen, it happened. So, when people need the coal, it can go anywhere. It's just a matter of how many ship miles it takes to get it there.
Yeah, indeed. In terms of things that floating steel, we've covered Transocean. Transocean versus Valaris seems to be the debate in the Twitter sphere, and I have both personally. How do you view the setup between the two? You mentioned Peabody's buyback program, making it a put writer's dream. It's been a covered call writer's dream over the last 2 years. Val has a similar type of a setup. How are you playing the offshore space in terms of Transocean versus Valaris?
Yeah, well, so I really love garbage. In almost every industry, I go for the laggard over the leader. But this one time, because Transocean didn't go through bankruptcy and all their competitors did, they are the ones, the technology leader and the fleet size leader also has the most financial leverage. So this is a very strange world where Transocean is the leader and the laggard. The reason why you would want to have a leader is that at the peak of the cycle, however many years from now that is, and I've heard some talking heads on CNBC when they mention oil services, they will mention Transocean by name, right? Carl Icahn was in it for a while. This is a name that the talking heads on CNBC know. And when the tourists come into the space, they go into the market leader. So at the peak of the cycle, it can have a higher multiple than its competitors. That's the attraction for being in a market leader. What's amazing about Transocean is right now it even has a lower multiple than its peers because they still have the debt, they have the financial leverage, and its peers are returning capital to shareholders, doing share buybacks, paying dividends. So this is a strange setup. I'm not in Valaris, mostly because I've listened to Transocean's earnings calls for a couple of years now, and I think the management deserves they deserve a lot of leeway. They've done a very hard job keeping the company out of bankruptcy and not wiping out shareholders since 2014. And it's genuinely hard to find prudent management that aren't just waiting to abuse shareholders at the drop of a hat. So I really do put a lot of confidence in Transocean's management team. They've done an incredible job. I think the Twitter space is really mad at Transocean, mostly because the stock price is down. But last year they were announcing a new contract like every month. Here's a new 1-year contract. Their order book was growing every month, but they were short-term contracts. And for the last two earnings calls, Transocean's management has said they're in the process of negotiating much longer-term contracts. The rise in day rates from 200,000 a day to 500,000 a day convinced their customers they needed to do longer-term contracts to lock in a price now and not have to pay much higher prices later. But those longer term contracts take much longer to negotiate because you have to have, Exxon or Chevron has to work it through their bureaucracy to spend, to commit to hundreds of millions of dollars for this, long-term contract. So they've said for 6 months that the contracts are coming, just trust us. And normally I'm highly suspicious of management. That's really the only safe way to be. But I do like Transocean's management. I don't see any reason why they would be fibbing about that, because the contracts that have been signed recently still have been at good day rates. It's not like day rates are falling. So we have last year a new contract every month, this year nothing. And I think the Twitter, Twitter army are just angry about the silence, right? They got, it was really nice to get a new press release every month about a new contract, because that would, that would bump up the stock price and everybody would say, we're so back, let's go. And now for months and months and months, it's been quiet and nothing. But at some point, it's probably some big contracts are going to get signed, but they could get signed for Valaris and Noble too, because they're competitors in the same space. So there's money for everybody. Everybody can make money in this space.
Yeah, I think so. And having spoken to a good friend of the channel, Mr. Tommy Deepwater, my thesis around Valaris tying up a lot of the fleet actually works better for Transocean longer term, because when they do go to renegotiate, there'll be much less of the available fleet. What can go wrong in terms of Transocean versus Valaris, which has the clean balance sheet, having gone through the bankruptcies? How do you view like a left tail risk, like say an oil spill happening in some region where Transocean's operating versus Valaris is operating? Does that factor into your calculations at all? Or you just think it's a risk across the whole sector? It is what it is.
Yeah, and that's so the Transocean was the owner of the Deepwater Horizon when that happened in the Gulf of Mexico how many years ago. So that can always happen. I mean, that can happen. It doesn't mean that we don't need offshore oil in the mix. And I mean, that could cause the oil majors to not want to sign any new contracts for a while. That could absolutely happen. I have heard that since the Deepwater Horizon, they've all become much more disciplined to try and prevent the next one, but it doesn't mean it can't happen. I mean, that risk is out there, but it's really not the sort of thing you can plan for, other than not having it be 85% of your portfolio, like Bruce Berkowitz does with the St. Joe Company. So there's not a similar kind of left tail risk with Florida real estate in the St. Joe Company. So he does go 85%. I wouldn't be 85% Transocean.
Yeah, that makes sense. You're the eagle, Degen. I'm the chicken. So I made some money on Transocean, and I said to myself, why do I need to? Let's time to spread out the portfolio a little bit here. Uh, and Uncle Bruce, I think he got in at a much better price. He's held those shares for quite some time. Transocean, valuation, equipment, seem to be in agreement that liquidity is not going to be an issue for the company. Let's say everything pans out without a left tail event. What are you going to exit? What kind of multiples are you going to exit for this type of company?
Yeah. If the multiples from the last cycle hold, that's $25 a share currently. And if they pay down any debt between now and then, it's $35 a share. But I predict sustained inflation. So if that takes 5 years to get there, who knows what day rates would be nominally by that time? Who knows what rebuild cost would be? I mean, there's a difference between a world where rebuild cost is 1.5 billion and 2.5 billion because of our 7% fiscal deficit and what that does to the US dollar. So, and this is one thing is stock prices are nominal. So they're susceptible to inflation. But just, and the multiples I was looking at is book value, and book value is what they paid for these pieces of equipment 10 years ago. So I don't spend too much time worrying about the terminal stock price until it gets a lot closer, because so much is going to change. But just, based on comparables, $25 to $35 a share is pretty reasonable.
Yeah, indeed. And it's a lot in what you say in terms of the embedded energy already having been spent in terms of the steel value, because in the sustained inflationary environment that we're expecting, that just acts like an extra, almost an extra call option on energy that's already been spent. The one thing we haven't spoken a lot about is Sibanye-Stillwater. I've mentioned it. You've written a very nice article about it. You are attracted to it because it's not a pure play. Talk to me about Sibanye Stillwater. what you think it could be worth moving forwards and why you're attracted to that particular company.
Um, so the management of Sibanye-Stillwater is trying to hedge risks within the company. So the participants, the active participants in the stock market, they want a pure play to exercise their thesis. The management of Sibanye-Stillwater says, well, the history of the company, they started out as a gold mining company, and then they went into platinum metals because it was another precious metal as a precious metals company. And then they realized that, well, platinum is also really more of an industrial metal, and all the demand for platinum is for catalytic converters for cars. But then cars are under threat by electric vehicles. So they built out Europe's largest lithium mine in Finland. And the idea is, well, if people do switch to electric vehicles, we'll have their lithium. And if they stay with internal combustion, we'll have their platinum. And if they do plug-in hybrids, they'll have both. And the idea is to be a third precious metals, a third platinum group metals, and a third battery metals. And it's kind of an internal risk hedging strategy, which in theory, right, if things are heading toward a discounted cash flow, if that reduces the volatility, you'd think it would fetch a higher multiple, and that's not working at all. This is not even remotely working. I do think there might be room for an activist investor to go in there and convince them to split up the company. I wonder what the Stillwater mine, U.S. domiciled, and their U.S. domiciled platinum recycling group, what that would trade for on the New York Stock Exchange as an American domiciled company. That might unlock a lot of value. But good luck trying to convince people to do that. I don't have enough capital to be Carl Icahn. I honestly have no clue what price it'll fetch in the next cycle. I did just listen to Rick Rule on your channel talk about Russia selling platinum. And coincidentally, right after Rick Rule said that, Russia announced that they're going to threat a palladium export ban, which to me says they've run out and they've sold it all. So if Rick Rule is right that they've been dumping platinum on the market and now they're saying, oh, watch out, America, we'll do an export ban, that means that they're run out. They sold it all. So I think you could see platinum group metal prices, go up pretty fast here. Who knows? I have no clue what price it'll fetch in the market, but I have been very impressed with their operations, the way they've outperformed their peers. They bought this zinc mine in Australia, and right after they bought it, they had a once in 100-year rainstorm, and the whole thing flooded. And it really it was a really amazing conference call to listen to, because it was just every single mine. There was a fire in the gold mine, and there was a shaft collapse, and there was a labor union strike, and everything was going wrong. And the very next earnings call, that zinc mine was profitable. And a lot of the naysayers are saying, oh, this is a waste. They'll never make money there. So I have been very impressed with their operations. But yeah, I think, we have to get to the stage where in the long run, it's a weighing machine, and they have to be, having big cash flows. Now, they don't have the best track record of returning capital to shareholders. They'll probably go out and buy more mines. But, that's not the worst thing.
Yeah, indeed. And in terms of this thing, are you looking at it on a potential cash flow return basis, or you're looking at a net asset value and giving it a big, massive margin of safety?
I mean, the margin of safety, this thing is just so unbelievably cheap.
Yeah.
When I look at, so you have what they paid for the Stillwater mine in the United States, and it's already cash flowed out their purchase price. So that's been the story with so many of their assets, that it's really just they keep on buying stuff, they keep on cash flowing out their purchase price, and they keep on operating well. And the price just seems unreasonable for what it is. I think mines are very hard to value, because you have to know what their costs are going to be. You have to know what the price of the metal is. I know that $4 a share is too low, but it's the margin of safety is so huge there. I mean, I was buying at $7 a share and $6 a share and $5 a share. I've been catching that falling knife, and that's why in that Sibanye-Stillwater article, I put a little catharsis in there, a little bit of healing for how much pain I've suffered through the love-hate relationship with Sibanye-Stillwater. But at some point, I think I'm going to get rewarded for that one.
Yeah, I certainly hope so, and I tend to agree. Last question before I let you go. We've moved through an inflationary thesis, value thesis, moving into from energy to metals. Gold is topical right now, and you mentioned that whenever you write about gold miners, you certainly get more and more people's attention on Substack. There's In Australia, we call them a roughie, kind of a dark horse on the outside gold miner called Equinox Gold. I have looked at it. I haven't taken a position yet, but it seems to be way too cheap. Why are you interested in Equinox Gold, apart from the obvious, which is Ross Beattie's at the helm of this thing?
Yeah, so I'm a generalist. I usually with a company, and I've been burned by, managerial bureaucrats making bad decisions for shareholders. So I try to focus on companies that has a strong capitalist with enough votes to guide them in the right direction, and somebody that has a lot of expertise in the space. And Equinox Gold, the chairman is Ross Beattie. He successfully built out Equinox Resource in the 1980s, sold it to Hecla Mining. He successfully built out Pan American Silver. So this is going to be his, seventh mine that was built and delivered on time and on budget. And that's amazing because you hear about this in the uranium space. How many of these junior miners are actually going to be able to deliver a mine that produces ore? And there's a lot of doubt there because it's not easy. It's not an easy thing at all. So just to have somebody that's done it successfully 6 or 7 times is as good of a bet as a generalist can make in a sector where you don't have your expertise. And it makes it much more a problem of time arbitrage, which investors are comfortable with, than especially explorers. Explorers are more like lottery tickets. You never kind of really know what kind of ore is in the ground. And I'm not very interested in buying lottery tickets, and I'm much more interested in buying time arbitrage with a management team with a good track record. That to me is a much safer bet. I think the Equinox stock price is in the toilet for two reasons. They had pre-sold, they had done a long-term sales contract for a lot of their gold at $2,000 an ounce. And then the price ran up to 2,300 an ounce. And the quarter that they announced that their average cost for the gold that they mined was 2,000 an ounce, the market didn't like that. The same thing just happened to Cameco, right? Uranium is $80, $90, and they sold their uranium for $56 because they have all these long-term contracts. So it's pretty standard when you have long-term contracts that you don't get the price adjustment immediately. That was one thing that I think really hurt Equinox's share price. And the other is for the financing of the build out of their large greenstone mine in Canada, they had 40% of the mine owned by a company called Orion. And Orion, after the completion of the build out of the mine, Orion went to sell that in the open market. And Equinox did not have any sort of right of first refusal. They didn't have any sort of ability to buy it at a discount. But they did want to own the mine. And they obviously know it better than anybody else in the marketplace because they built it. But they bought it as the highest bidder at an open auction. And the price they paid for it was pretty standard, right? The price they paid for it wasn't a discount. It wasn't cheap. It probably wasn't overpaying. It probably was a fair price. Now, if the price of gold goes up, it'll look cheap in hindsight. But at the moment, the market doesn't like it. Something similar happened to Hudbay Minerals. It's a copper miner position I have that I haven't written about yet. They did an all-stock transaction to buy Copper Mountain, and initially the market didn't like it. But then the price of copper runs up, and they say, oh, that acquisition wasn't dilutive at all. That acquisition was fantastic because now we have another copper mine and the price of copper ran up. So I think the Equinox buying out all of their greenstone mine, even though they paid $1 billion for 40% of it, I think over time they're going to be the marketplace will be pretty happy with it. Right now, I think the price is too cheap, just because whenever shareholders hear of dilution, they're really unhappy about it. But when you have a business that's 8 or 10% owned by a capitalist like Ross Beattie, he's not going to dilute himself unless it's a good idea. And that's as opposed to if you have a company like Eagle Bulk Shipping, which is just run by managers and bureaucrats, they agreed to get acquired at $56 a share, and they had $80 a share of ships. They could have just sold all their ships in the open market and paid all their shareholders $80, and instead they agreed to be acquired at $56. And so I've been burned enough time by investing in companies that don't have a capitalist making decisions. So I'm trying to avoid managers and bureaucrats.
Certainly makes a lot of sense. It all depends on the incentives. Show me the incentives and I'll show you the outcome. Well, this was an absolute pleasure. I can't wait to have you back on the channel. Perhaps we can talk about some of those copper positions. Guys, Unemployed Value Degen Substack. Details will be in the description. Is there anything I missed that you would like to add before we wrap up?
No, just thank you for having me on. You know, everybody who retweets or restacks it goes a very long way. I'm grateful for anybody who helps me get a little bit more exposure out there. I think the community has been so supportive and fantastic. I mean, on Substack, maybe less so on Twitter, but it's been a fantastic 3 weeks since I started writing.
You're doing very well, sir. Keep up the good work. I, for one, am a fan. Guys, make sure subscribe, retweet, and restack. And I look forward to catching you in another episode of the ROI podcast. Take care.